Welcome to Stress-Free Investing Analysis Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
All right, today's explainer is a classic fallen angel setup. We're looking at a structurally excellent company that's currently trading at decade lows. We'll logically break this down into 5 parts: the engine, the fortress, the plot twist, the opportunity, and finally, the verdict. Let's dive right in.
Part 1. The engine, specifically looking at their role as an affordable housing specialist. Aavas Financiers is totally laser-focused on low to middle-income housing finance, specifically out in semi-urban and rural India. This is a chronically underserved market. Traditional banks, they usually just skip it. But for Aavas, a massive 62% of their portfolio goes straight into home purchases, and another 22% funds home construction. Basically, they're financing the literal foundations of rural and semi-urban housing, primarily targeting first-time buyers with an average loan size of around 12 to 18 lakh rupees. So what's their actual edge here? It's a very narrow, highly specialized moat, underwriting informal income. We're talking small traders, daily wage earners, or self-employed folks who just don't have standard salary slips. Big banks won't touch them. But Aavas has spent 12 years building proprietary models to figure out exactly how to assess their risk. And they combine this with a sprawling physical footprint of 435 branches across 15 states, plus a serious digital upgrade that recently cut their loan processing time in half. It's this perfect blend of high-touch physical verification and high-tech efficiency. Moving on to Part 2, the fortress. Let's look at their pristine financials and sector-leading metrics. Now, to understand just how rock-solid their balance sheet is, we have to remember the golden rule of housing finance companies. You've got to toss out your standard manufacturing metrics. Forget about EBITDA or free cash flow. They're totally meaningless here, right? An HFC's raw material is literally just deploying capital. So we're judging them strictly on their own turf: net interest margin, asset quality, and price-to-book ratio. And honestly, their FY26 numbers are just pristine. They recently blew past 23,450 crores in assets under management. But the absolute standout? That sector-leading 7.93% net interest margin. That kind of margin proves they have massive pricing power in this informal segment. Plus, even though they lend to people without formal income proofs, their gross non-performing assets sit at an incredibly low 1.05%. That is best-in-class asset quality, proving their models actually work. Oh, and their return on assets is bouncing back nicely to 3.29%. And if you want financial stability, how about a staggering 44.56% capital to risk-weighted assets ratio? For context, the regulatory minimum set by the National Housing Bank is just 15%. Aavas is sitting on almost 3 times what's required. Translation, they've got a massive runway of liquidity to grow their loan book without needing to dilute equity and raise fresh capital anytime soon. Which brings us to Part 3, the plot twist. Let's talk about slowing growth and the catch. Okay, so here's the elephant in the room. If the moat is so good and the financials are this perfect, why on earth is the stock down roughly 33% from its highs? Well, the answer is severe leadership turbulence. The founder, Sushil Kumar Agarwal, built this engine and scaled it brilliantly until 2023, when he stepped down. Then saw Chinder Binder stepped in, but right after that, global private equity giant CVC Capital Partners bought out the promoter stake and brought in Manu Singh. That is 3 different CEOs in just 3 years. For a quality-driven financial institution, that level of executive churn really shakes the market's confidence. And you can see the direct fallout of that churn in the growth numbers. Assets under management growth dropped from a blistering 26% in FY23 down to 20% and then bottomed out at just 15% in FY26. That kind of deceleration absolutely spooked institutional investors. Foreign institutional investor holdings actually dumped from over 31% to under 24% in a 2-year window. The market hates uncertainty, especially when it starts eating into top-line growth. But here is where things get interesting. Part 4, the opportunity, featuring a rare decade-low valuation. Because of all that turbulence and institutional panic, we're now looking at a highly asymmetric setup. Today, Aavas is trading at a historically rare 2.14 times price-to-book ratio. To put that into perspective, this is literally the absolute lowest valuation since they went public back in 2018. At its peak, this thing traded at 8.5 times its book value. So at 2.14, the market has completely priced in all the worst fears about leadership and slowing growth, while basically ignoring the pristine asset quality and those killer margins we just talked about. So, what is the catalyst to turn this around? It honestly all hinges on the new private equity promoter. Look, CBC Capital is a 200 billion euro fund. They need a profitable exit eventually, which means they are highly motivated to fix this growth issue. The roadmap is pretty simple. First, the new CEO, Manu Singh, needs to stabilize operations in Q1 of FY27. We actually already saw Q4 FY26 disbursements jump 36% quarter over quarter, so that's a very solid early signal. Second, AUM growth needs to rebound to CBC's target of 18% to 20%. If they pull that off and restart the engine, this stock is primed for a massive mean reversion, re-rating right back towards a 3.0x or higher price-to-book multiple. Let's map the math out on this, because the asymmetry here is wild. In a bear case, meaning new leadership totally drops the ball and fails to revive growth, the downside risk sits at about a 27% drop to $1,050. But look at the base case. If growth just normalizes back to that 18% to 20% range, we're looking at a target of $1,725, which is a 19% upside. And in a bull case, where they really nail the strategy and the market gives them back their historical multiples, you're looking at an upside stretching to 59%, targeting $2,300. So you're balancing a 27% downside risk against a potential 59% upside. That gap is exactly why this opportunity matters. Finally, let's wrap this up with part 5, the verdict on calculated accumulation. So how do we actually play this? The verdict here is a calculated accumulate. You've got a structurally elite franchise on sale simply because of a fixable transitional hiccup. The move here is to build a position gradually. You want to watch the Q1 FY27 results like a hawk. If AUM growth hits 17% or higher, that's your ultimate confirmation signal. You'd want to hold this for a 2 to 3 year horizon to let the mean reversion actually play out. But crucially, since we are still dealing with leadership unknowns, you have to keep a strict stop loss at $950. If it breaks below that, the price-to-book ratio drops below 1.4, which is the market screaming that the transition failed and this has officially become a value trap. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.